Everybody's talking about AI. I mean, from Silicon Valley to Wall Street, billions upon billions of dollars are just pouring into this space. But as these company valuations soar into the stratosphere, there's a huge question echoing through the halls of global finance. Are we living in a massive AI bubble? And is it about to pop?
So let's just dive right in. This isn't some hot take from a pundit on TV. No, this is a direct warning from the head of the International Monetary Fund. She's comparing the AI frenzy right now to the dot-com bubble. And look, when the IMF starts sounding alarms like that, it's a signal you really can't afford to ignore.
And the IMF? They're not alone on this, not by a long shot. We're seeing other major financial institutions saying the exact same thing, publicly warning about a potential, and I'm quoting here, sharp market correction. You know, the whispers about a bubble have pretty much grown into a deafening roar at this point. I mean, look at this list. This isn't just one person with a contrarian view. It's a whole chorus of concern. We're talking about the Bank of England, seasoned investors who've seen these cycles play out for decades, top economists. The consensus is pretty clear. The AI market is showing all the classic signs of overheating. So what exactly is it that they're seeing that has them so worried?
Well, to really understand their concern, we kind of have to dissect this thing. We need to look at the anatomy of this potential bubble, piece by piece, and examine the indicators that suggest this isn't just healthy growth, but maybe a full-blown speculative fever.
First up, the valuations. The Bank of England calls them stretched. Some investors are just calling them bonkers. And you can see why. OpenAI's valuation more than tripled in just 1 year. Anthropic's almost tripled in a matter of months. And then you have a company like Palantir trading at over 200 times its expected earnings. I mean, these are numbers built on a dream of what might happen in the future, not what's happening today.
Okay, next, look at just how top-heavy the market has become. Right now, just five tech giants make up 30% of the entire value of the S&P 500. We have not seen that level of concentration in over half a century. And the risk there? Well, it's pretty obvious. If one of these few AI-focused behemoths stumbles, they could drag the whole market right down with them.
And here is the real kicker. This is the big disconnect. Despite all the hype, despite the trillions in market value, a recent report from MIT found that a staggering 95% of businesses using generative AI have seen absolutely zero return on their investment. Zero! This is a classic bubble indicator. The price tags are soaring, but the real-world value just isn't there yet.
So that just begs the question, right? If the payoff isn't there, is this whole thing just pure speculation, a dream? And you get this feeling of déjà vu, which it leads us to some really important historical parallels. Because when bubbles pop, the fallout can look dramatically different depending on why it popped. And history gives us two powerful and very different warnings for what could happen here. The dot-com bust of 2000 and the financial crisis of 2008.
Now, understanding the difference between these two is absolutely crucial. The dot-com bust, that was mostly investor speculation. It was painful for sure, especially for tech investors, but it didn't crash the whole system. And what it left behind was incredible, the basic infrastructure for the internet we use today. But 2008, that was fueled by bad debt, and it caused a systemic failure that almost brought down the entire global economy. By the way, if you're enjoying this breakdown, do me a favor and hit that like button and subscribe for more deep dives like this.
Okay, and this is where the current situation starts to get a little scary. See, this AI boom isn't just being paid for with cash. Big tech is taking on a record-breaking $250 billion in debt to build data centers and buy up all these chips. And that reliance on borrowing, well, it starts to blur the line between a contained dot-com-style pop and a much more dangerous 2008-style crisis. So, if we all agree we're in a bubble, the obvious move is to get out, right? Sell everything. Well, not so fast. There is a huge problem with that strategy, and it's called the prediction paradox. Timing the pop is almost impossible, and being right too early is effectively the same as being wrong. Just look back at the dot-com bubble. Some of the sharpest minds in finance saw it coming years in advance. Ray Dalio was ringing the alarm bells way back in 1995. But the market just kept ripping higher for another 5 years. It soared over 1,000% and absolutely crushed anyone who was cautious too early. Even a legend like George Soros lost a fortune betting it would crash sooner than it did. And this story, man, this story perfectly captures the paradox. Julian Robertson was a legendary investor. He knew the market was irrational, so he stayed out of the mania.
But the market stayed irrational for so long that his own clients lost patience and pulled their money out, forcing him to close his fund on March 30th, 2000. The cruel, cruel irony. The bubble had picked and started its historic crash just 2 days earlier. He was right. He was completely right. But his timing was off by a hair, and it cost him everything.
So, if trying to predict the exact moment of the pop is a fool's game, what should we be focusing on? Maybe the more important question isn't when it bursts, but what happens after. Because the legacy of this bubble is what's really going to shape our future. I think the California gold rush is a perfect analogy here. You had thousands of people rushing west, dreaming of striking gold. Most of them went bust, found nothing. The real fortunes were made by the people selling them the shovels and the pickaxes. But even with all those individual failures, the frenzy itself is what built the infrastructure of modern California.
And that analogy gives us two very different potential futures for AI. Is the pop going to trigger a 2008-style crisis that cripples the financial system for everyone? Or is it going to be more like the dot-com pop, where, investors get burned, but the world is left with all the valuable shovels, the data centers, the chips, the models that will power the next big thing?
But there's one final, really unsettling twist to this whole thing. The gold rush analogy only works if you assume the gold is actually real, even if most people can't find it. What if, in the case of AI, the gold itself is a mirage? What if all these billions are being aimed at the wrong technology? I mean, leading AI scientists, including guys who have won the Turing Award, the Nobel Prize of Computing, are arguing that large language models, the tech behind ChatGPT, are basically a dead end. They think true human-level AI needs a totally different approach. And if they're right, it means not only is there no gold, but all the shovels we're building are useless for digging anywhere else.
And so, that's where we're left. The real question isn't if the AI bubble will burst, but what it's going to leave behind when it does. Will it be the infrastructure for a new world, a devastating crater in the global economy, or, in the worst-case scenario, just a whole lot of nothing? That is the multi-trillion-dollar question.